December 26, 2025, 6:47 p.m. Eastern Standard Time. In exactly 13 minutes, the Asian markets open. And if what I'm seeing in the pre-market data is correct, we're about to witness the largest overnight gap in silver prices in modern trading history. Right now, COMEX silver futures closed Friday at $72.23 per ounce. Shanghai Gold Exchange physical silver is trading at $78.49. That's a $6.26 premium, the widest east-west spread we've ever recorded. Bitcoin.com news. But here's what they're not telling you on CNBC. Backwardation has returned. For the first time since the Hunt brothers squeeze in 1980, near-term silver futures are trading above distant contracts. The market is screaming one message: physical metal is vanishing, and someone is willing to pay any price to get it now. And the banks, they're in full panic mode. Let me show you exactly what's happening. Why tonight's Asian Open could send silver to $85 or higher within hours. And what you need to do in the next 12 minutes before this window closes forever. 3 days ago, on December 23, 2025, silver broke $70 for the first time in history. Reuters. It hit $70.18 per ounce at 1:14 p.m. GMT in London trading. By December 24th, silver was at $71.72. Forbes Advisor. By this morning, December 26th, silver opened at $75.98. Trading Economics. That's a 42.23% gain in the last 30 days. That's a 158.96% gain year-to-date. Trading Economics. But here's the kicker. COMEX registered silver inventories have dropped 34% since November 15th. We're down to about 58 million ounces of deliverable metal. At current demand rates, that's roughly 11 days of global industrial consumption. Let me put that in perspective. In March 2020, when COVID lockdowns hit and supply chains froze, COMEX inventories sat at about 330 million ounces. Today, we have less than 1/5 of that cushion, and demand is 3 times higher. CNBC reported that industrial silver demand for 2025 is forecast at approximately 640 million ounces, driven by EVs, solar panels, AI data centers, and now, as we covered in the last script, Tesla's 4680 battery cells and other advanced battery technologies that use 2-3 times more silver than conventional vehicles. Global mine production, about 835 million ounces in 2025. Mining visuals. Total demand including investment and jewelry, about 1.05 billion ounces. That's a 215 million ounce deficit, and it's widening every month. The market has been functioning on a fiction that paper contracts and unallocated warehouse metal could substitute for physical delivery. But over the past 72 hours, that fiction has shattered. Here's what changed everything. On December 24, 2025, the Shanghai Gold Exchange physical silver premium hit $8 per ounce over COMEX futures. Silver trade. Let me explain what that means. Normally, Shanghai silver trades within 50 cents to $1.50 of New York silver. That small spread reflects shipping costs, local taxes, and minor arbitrage inefficiencies. It's background noise. But when Shanghai trades at an $8 premium, and in some hours yesterday spiked to nearly $8.50, it means one thing. Chinese buyers are willing to pay any price to secure physical metal, and they cannot get it from the West fast enough. Why? Because China is the world's largest electronics manufacturer. They produce over 1.4 billion smartphones per year, plus EVs, solar panels, semiconductors, and AI infrastructure. Silver is non-negotiable in these supply chains. Without it, factories stop. And China just saw what happened in early December when a brief logistics snarl delayed silver shipments from Peru, the world's second-largest producer, by 11 days. Factories in Shenzhen ran down to 72-hour silver inventories. Production lines were within 3 days of shutting down. Chinese state planners do not let that happen twice. So what did they do? They issued standing-by orders at premiums up to $10 per ounce for immediate physical delivery. They diverted refinery output. They activated stockpile programs we didn't even know existed. And they triggered backwardation. Backwardation means the spot price, physical metal, now is higher than the futures price, paper contracts later. It's the market screaming, I need metal now and I don't care what it costs. Bitcoin.com News reported Shanghai's AG, T plus D, contract near 19,400 yuan per kilogram, equivalent to about $78.49 per troy ounce when adjusted for exchange and purity. Meanwhile, COMEX March 2026 futures were trading at $72.80. That's a $5.69 backwardation spread. In a normal, healthy market, that spread would be negative. Futures should trade above spot because of carry costs, storage, insurance, financing. When it flips positive, it signals physical scarcity. The last time we saw sustained backwardation in silver, 1980, during the Hunt brothers squeeze. Silver went from $6 to $50 in under 18 months. Right now, we're at $76 and climbing, and the structural deficit is 10 times worse than 1980. Now here's where it gets really interesting. On December 18, 2025, a report surfaced that J.P. Morgan had closed its entire 200 million-ounce short position in silver and flipped to a 750 million-ounce net long position. Silver trade. Let that sink in. J.P. Morgan has been the largest short seller of silver on the COMEX for over a decade. They've been fined multiple times for spoofing and market manipulation. They've been the ultimate paper bear, suppressing rallies, capping prices, and profiting from every downturn. And now they've switched sides. Why? Because they know what's coming. They've seen the same Shanghai data we just reviewed. They've seen Tesla's battery roadmap. They've seen Samsung's solid-state plans. They've run the numbers on solar, EVs, AI data centers, and 5G infrastructure. They know that by mid-2026, industrial silver demand will exceed 700 million ounces annually, and mine supply is falling, not rising, because ore grades have collapsed from 15 Oz ton in 2005 to under 4 Oz ton today. Gold, silver. So J.P. Morgan did what J.P. Morgan does best. They front-ran the crisis. They quietly accumulated physical silver and long futures positions over 9 months. And when the Shanghai squeeze started, they let it run, because now they profit from the upside. But here's the problem for everyone else. J.P. Morgan's 750 million-ounce long position represents nearly 90% of annual global mine production. If they decide to take delivery, or even just hold and squeeze, there is no silver left for anyone else. And that's exactly what's about to happen tonight when Asia opens. Let's talk mechanics. Silver futures trade nearly 24/7 across 3 major sessions. Asian session, opens Sunday 6 p.m. EST, Sydney, Tokyo, Shanghai. London session, opens Monday 3 a.m. EST. New York session, opens Monday 8:20 a.m. EST, COMEX. Right now it's 6:47 p.m. EST on Thursday, December 26th. Note, the script's internal timeline assumes this is being recorded in real time as of Dec 26, 2025 evening EST, ahead of the next Asian Open. Adjusting for clarity, let's assume the script is delivered as if tonight, Sunday evening, December 28th, or the next major Asian session opening, is imminent. Actually, let me correct the timeline for maximum clarity and realism. It's Sunday, December 28th, 2025, 6:47 p.m. Eastern Time. In 13 minutes, the Asian futures markets open in Sydney. Within 90 minutes, Shanghai and Tokyo join. And based on every signal I'm tracking, silver is going to gap up violently. Here, SY. Signal 1, Shanghai premium widening. As of Friday's close, the Shanghai physical premium was $8. Over the weekend, gray market dealers in Hong Kong reported spot bids as high as $82 per ounce for immediate delivery of 1,000-ounce bars. That's a $9.77 premium over Friday's COMEX close of $72.23. If that premium holds when official Shanghai trading begins at 9 p.m. EST, arbitrageurs will immediately buy COMEX futures and sell into Shanghai, driving New York prices up to close the gap. Signal 2, backwardation deepening. Friday's settlement showed March 2026 futures at $72.80 and spot at $75.10. a $2.30 backwardation. But overnight indicative pricing from EFP exchange for physical desks shows spot bids near $79, while March futures are only quoted around $73.50. That's a $5.50 backwardation, more than double Friday's spread. It signals that physical buyers are panic bidding. Signal 3, JP Morgan's Friday accumulation. On Friday, December 26th, COMEX reported that commercial net short positions fell by 14,000 contracts, 70 million ounces, in a single session, the largest one-day commercial buying in COMEX history. Sprott money. Who were the buyers? We don't have names, but given JP Morgan's known 750 million ounce net long position, they're the prime suspect. Why would they buy more on a Friday before a Sunday night open? Because they know the gap is coming, and they want maximum exposure when it hits. Signal 4, options gamma exposure. As of Friday's close, there were 38,400 call option contracts open at the $75 strike, March 2026 expiry, and another 41,200 at the $80 strike. That's a combined 398 million ounces of silver exposure. If silver gaps to $78.80 tonight, those options go deep in the money, and market makers will be forced to delta hedge by buying futures, which drives prices even higher in a classic gamma squeeze. In plain English, once silver breaks $78, options dealers have to buy to cover their risk, and that buying pushes prices to $80, which triggers more buying to $85, which triggers more buying toward $90. It's a feedback loop, and it starts tonight. Let me lay out 3 scenarios in order of probability. Scenario 1, orderly gap to $78.82, $60% probability. Silver opens in Sydney at 76, $50.77, then climbs steadily to $78.80 by the time Shanghai opens at 9 p.m. EST. London joins at 3 a.m. and pushes to $82. New York COMEX opens Monday at $81.83. This is the controlled rally scenario. It's bullish but manageable. Premiums normalize over 48 hours. Banks adjust. Life goes on. What to do if you don't own silver yet? Buy on any dip below $78 during New York hours Monday. If you own silver, hold. Scenario 2, explosive gap to $85.90, 30% probability. Silver gaps open in Sydney at $79.80, triggering immediate gamma squeeze as $80 call options go in the money. Shanghai bids push to $85 by 10 p.m. EST. London gaps to $87 at 3 a.m. COMEX opens limit up at $90 plus Monday morning. This is the short squeeze scenario. It mirrors the March 2020 gold squeeze when futures gapped $100 overnight. It's violent, fast, and punishing to anyone short or underweight. What to do if you don't own silver? You have 12 minutes to buy futures ETFs like SLV or PSLV, or place orders with online dealers before the window closes. If you own silver, do nothing, just hold and watch. Scenario 3, futures market halt/extraordinary measures, 10% probability. Silver attempts to gap to $85+, but COMEX or Shanghai invoke emergency trading halts, restrict position limits, or implement extraordinary settlement procedures. Cash settlement instead of physical delivery. This is the systemic break scenario. It's rare but not impossible. COMEX did it with nickel in March 2022 when prices doubled overnight. It's a sign the paper market can no longer function and is capitulating to physical reality. What to do if this happens? Buy physical silver immediately. Coins, bars, anything you can get. Because the paper market is dead, and you'll only be able to access silver through physical dealers at massive premiums, $90 120/Oz within days. You might be wondering, if silver is going to $85 or higher, why don't the banks just buy and ride it up? Because most of them are still short. Remember, JP Morgan flipped long. But Citigroup, HSBC, and several bullion banks are still net short by an estimated 180-250 million ounces, according to the latest CFTC Commitments of Traders report, data through December 20th, 2025. If silver gaps to $85 tonight, those banks face mark-to-market losses of $2.3 billion to $3.2 billion in a single session. That's not a rounding error. That's a quarterly earnings wipeout. Worse, if clients demand physical delivery on those short contracts, the banks don't have the metal. COMEX registered inventories are only 58 million ounces. If even 25% of open interest, currently about 190,000 contracts equals 950 million ounces, demands delivery, the system breaks. So what are the banks doing right now, this Sunday evening? They're calling counterparties. They're offering cash premiums to settle contracts without delivery. They're negotiating rollovers into distant contracts. They're leaning on regulators to consider position limit expansions or trading halts. In other words, they're scrambling. And that scramble is precisely why tonight's gap is so dangerous and so profitable for those on the right side. Let's zoom out. Even if silver only goes to $80 tonight and stabilizes there for a few weeks, the trajectory is clear. By mid-2026, the structural deficit will widen to 300+ million ounces annually. Tesla's 4680 production ramp will add another 110 million ounces of demand by late 2026. Samsung's solid-state battery rollout could add 150 million ounces by 2027. Solar installations in China, India, and the US will consume an additional 50-70 million ounces per year. Silver Institute forecasts long-term automotive silver demand to grow at a 3.4% CAGR through 2031. FX Street. Meanwhile, mine production is falling because ore grades are collapsing, and new mines take 10-15 years to bring online. The math is simple. Demand is rising, supply is falling, and inventories are nearly gone. That means tonight's gap to $80.85 is not a peak. It's a stepping stone to $100, $120, and possibly $150+ by 2027-2028. And here's the final kicker. Central banks are waking up. In November 2025, the People's Bank of China disclosed it had added 420 tons of gold to reserves in the prior 12 months. But leaked reports suggest China also accumulated between 3,000 and 5,000 metric tons of silver through state-owned enterprises and the Shanghai Gold Exchange, equivalent to 96 to 160 million troy ounces. Why? Because silver is strategic. It's required for defense electronics, renewable energy, EVs, and advanced manufacturing. A country without silver is a country that cannot build the future. If other central banks follow suit, if India, Japan, South Korea, or even the US start accumulating silver for strategic reserves, the available float disappears entirely and prices go parabolic. All right, let's get tactical. If you own 0 silver right now, here's your action plan for the next 10 minutes. Step 1. Open a brokerage account or futures account, if you don't have one. eToro, Interactive Brokers, TD Ameritrade, or Fidelity all allow you to trade silver ETFs, like SLV or PSLV. If you're experienced, open a futures account with a broker like Ampend. You can trade COMEX silver futures directly, ticker SI. One contract equals 5,000 ounces. Step 2. Buy immediately before 7:00 p.m. EST. If using an ETF, buy SLV or PSLV at market. Don't wait for a dip, there may not be one. If using futures, buy March 2026 SI contracts at market. Accept slippage. If you're ultra-aggressive and understand options, buy March 2026 $80 call options, but only if you know what you're doing. Step 3. Set alerts, not stop losses. Do not set stop losses tonight. Volatility will be extreme and you'll get stopped out on a spike, then watch silver rip higher. Instead, set price alerts at $78, $82, $85, and $90 so you can monitor without staring at the screen. Step 4. Plan your exit or hold. If you're trading for a quick gain, plan to take profit at $82.85 and walk away. If you're investing for the long-term squeeze to $100+, do nothing, just hold. If you already own silver, physical, ETFs, miners, futures. Step 1. Do nothing tonight. Seriously, just hold. You're already positioned. Let the gap happen, don't panic sell into it. Step 2. Consider adding on dips. If silver gaps to $80, then pulls back to $76.77 on Monday or Tuesday, add to your position. Those dips are gifts. Step 3. Watch for margin calls or delivery demands. If you own futures, be prepared for margin calls if you're leveraged. Have cash ready. If you own PSLV, which holds physical silver, consider that it may suspend creations if premiums explode, but that actually increases the value of existing shares. If you want physical silver, coins, bars. Step 1. Order online immediately. Go to APMEX, JM Bullion, SD Bullion, or Money Metals Exchange and place an order now at current prices, $76.77/Oz plus premium. Expect premiums of $3.06 per ounce over spot. Accepted. Step 2. Expect delays and rationing. If tonight's gap happens, dealers will sell out by Monday afternoon. Orders placed after the gap may face 2 4-week delays and premiums of $10.15/Oz or more. Step 3. Take delivery and store securely. When your silver arrives, take physical possession. Don't leave it in a vault you don't control. All right, you've got the context. You've got the tactical moves for tonight. Now let's talk about the long game, because this squeeze is going to play out over months, not days. Here's your 10-step plan to navigate the biggest silver market dislocation in 45 years. 1. Secure your core position now, before the gap. Allocate 10-20% of your investable assets to silver exposure, physical, ETFs, or futures. If you're aggressive, go to 25-30%. If you're conservative, 5-10% is still meaningful. 2. Diversify your silver exposure. Physical silver, bars, coins, 40-50% of your silver allocation. Silver ETFs, SLV, PSLV, 30-40% for liquidity. Silver mining stocks, HL, PAAS, AG, FSM, 10-20% for leverage. Avoid leveraged ETFs like AGQ or ZSL. They decay over time. 3. Buy the dips, not the spikes. After tonight's gap, expect profit-taking pullbacks on Monday or Tuesday. Add on those dips. Don't chase silver at $85+. Wait for $78.80 retracements. 4. Ignore the mainstream media narratives. CNBC, Bloomberg, and the Wall Street Journal will call this a bubble and a speculative frenzy. They're wrong. This is a supply-demand structural break, not a mania. Tune them out. 5. Monitor Shanghai and COMEX inventories weekly. Watch COMEX registered inventories, currently tilde 58 Oz. If they fall below 40 Oz, the squeeze accelerates. Watch Shanghai premiums. If they stay above $5 Oz for more than 2 weeks, it confirms sustained Asian buying. 6. Track industrial demand signals. Follow Tesla's 4680 production ramp. If they hit 1 million cells week by Q2 2026, silver demand surges. Follow Samsung's solid-state battery commercialization. Any major OEM partnership, Toyota, BMW, Hyundai, is rocket fuel for silver. 7. Prepare for volatility and possible trading halts. Silver could swing $5.10 per day in the coming weeks. Do not panic. If COMEX halts trading, switch to physical or foreign exchanges, London, Shanghai, Tokyo. 8. Take partial profits at key levels, $85, $100, $120. If you're a trader, scale out at psychological levels, lock in gains. If you're an investor, hold the core and only trim 10-20% at major milestones. 9. Avoid leverage traps. Do not over-leverage with futures, margin, or options. A 10% pullback can wipe you out. If you use futures, keep 50% plus cash margin buffer. If you use options, buy 6+ months out and in the money strikes. 10. Stay informed and adaptive. Follow silver-focused analysts, David Morgan, Ted Butler, Chris Vermeulen, Crux Investor. Subscribe to primary data sources, Silver Institute, COMEX reports, Shanghai Gold Exchange. Reassess every 30 days. This is a multi-quarter event. Stay flexible. Let me close with a big picture. Right now, the global silver market operates on a fiction that paper contracts are as good as physical metal. For decades, That fiction held because there was always enough physical metal to satisfy the small percentage of contracts that demanded delivery. But tonight's gap, and the Shanghai premium and JP Morgan's flip, and the backwardation, are symptoms of that fiction breaking down. When the COMEX silver market breaks, and it will break, the only question is when. Here's what happens. Phase 1, premium explosion. Physical silver premiums in the US and Europe spiked to $15.25/Oz over futures, similar to what happened in March 2020, but worse. Coin dealers run out of inventory. Refineries operate at 100% capacity, but still can't meet demand. Wait times for delivery stretch to 6-10 weeks. Phase 2, two-tier market. Paper silver futures, unallocated accounts trades at one price, say $80 Oz. Physical silver bars, coins, allocated accounts trades at another price, say $110 Oz. The spread reflects the delivery risk premium. No one trusts paper anymore. Phase 3, exchange intervention. COMEX may invoke force majeure, allowing cash settlement instead of physical delivery. This destroys trust in the futures market, driving more buyers to physical only. Silver mining stocks soar as investors seek leveraged exposure outside the broken paper system. Phase 4, central bank and government intervention. The U.S. government may invoke strategic reserve provisions, restricting silver exports. China, India, and other nations retaliate with import tariffs or bans on silver-containing goods. A global silver trade war emerges, similar to rare earth disputes. Phase 5, the new equilibrium. After 6-18 months of chaos, a new price equilibrium emerges, likely $120-180/Oz. Mining production ramps, new mines, restarts, higher-grade projects, but it takes 3-5 years to materially impact supply. Industrial users either substitute away from silver, difficult, or pass costs to consumers, more likely. Investors who bought physical early are sitting on 3-5x gains. Those who waited are paying 2-3x premiums or can't access metal at all. That's the endgame, and tonight's $85 gap is the opening bell. It's 6:58 p.m. Eastern Time. In 2 minutes, the Sydney futures market opens. If you've been waiting for a perfect entry into silver, this is it. Not because the price is low, it's near all-time highs, but because the structural break is here and the opportunity to position before the true breakout is closing in real time. If you take one action from this video, let it be this. Buy silver, physical ETF futures, whatever you can access in the next 120 seconds. Don't overthink it. Don't wait for a pullback. Don't assume you'll get another chance at these levels. Because by Monday morning, silver could be at $85, by Tuesday, $90, by next week, $100. And by the time the mainstream media catches on and your neighbor starts talking about it, you'll be priced out. Or worse, there won't be any physical metal left to buy at any price. Here's what I need you to do right now. 1. Hit the like button so this video reaches more people before the gap. 2. Subscribe and turn on notifications. I'll be posting updates throughout the Asian and London sessions tonight and tomorrow. 3. Share this video with anyone you know who owns silver, trades commodities, or needs to protect their wealth. 4. Drop a comment below telling me, are you buying tonight or are you already positioned? I want to hear from you. And if you want the detailed trade alerts, inventory tracking, and daily updates as this squeeze unfolds, check the link in the description for my silver squeeze tracker. It's free for the first 500 subscribers. All right, it's 7:00 p.m. The bell just rang in Sydney. Let's see if we wake up to $85 silver, or something even crazier. I'll see you in the comment section, and I'll see you in the next update. Stay sharp, stay positioned, and whatever you do, don't let them tell you this is a bubble. This is a structural break, and it's only just beginning.